Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, audience and listeners. This is James Kandasamy from Achieve Wealth through Value-Add Real Estate Investing podcast, where we bring in high-quality commercial real estate operators to be interviewed. Last week, we had Todd Dexmeyer from Midwestern states. He's killing it in that area where he focuses a lot on buying multifamily in that area. And, imagine he started buying mobile home park and ski resorts and later on ended up in multifamily. So you want to check out that episode. This week, we have Joseph Bramante from TRIAC Real Estate Partners, who's based out of Houston. And they buy deals in Corpus Christi, Houston, and Victoria. And Joseph owns and control almost 600 units on his own, and it's another 300 to 400 units as a fee manage. Hey, Joseph, welcome to the show.
How's it going? Thank you. Thanks for having me.
So very happy to have you here, and thanks for coming on the show. I want to go deep into your, what are the deals type that you're buying, and can you give a brief introduction on when did you get started and the sequence of purchases that lead up to current 600 units and another 300-400 fee managed properties?
Yeah, so I got my start in 2011. I bought a 26-unit apartment complex. I was still working in corporate America. I was an engineer for Exxon at the time, working overseas. I actually lived in Papua New Guinea when I got my start. So we were living in a compound in Papua New Guinea, had more money than any 24-year-old should have, and got the bright idea to, buy multifamily. And there's more to the story, but to keep it short, we decided to buy an apartment complex, and we found the property, bought it, and did basically almost everything wrong that you could do on your first acquisition. And we spent the next 3 years kind of learning how heavy value add multifamily works. The one good thing we did on my first deal was we bought it in a great location. It's really close to the Galleria. And over a 3-year period, we leased the whole property down, did a $30,000 per unit renovation, and then leased it back up and doubled the rents, which, my mentors at the time were telling me, sell the property, take a loss, see if you are not qualified to do this. And for the most part, they were correct. But nonetheless, we did it. We got double all of our money back, over 200% return. And obviously the mentors didn't really like that so much when I didn't take their advice, and made not only didn't lose money, but doubled my money. And then that was kind of my flag in the sand to the rest of, I was a part of I joined a real estate group at that time between purchasing and selling, or purchasing and refinancing that property. Still own it today, and use that success and that track record, as small as it was, to raise capital and buy more value-add deals. And over the next 4 years, we bought almost a deal per year, sold one deal, and was really just kind of laying the foundation for our owner management stuff. Because there's owner management is really, multifamily is really involved. And I know people try to make it sound like it's really simple. And I see these guys that are growing these massive portfolios almost overnight. But there's a lot of foundation work that you have to build in order to really even grow that. There's a big difference between going from 1,000 units, from 100 units to 1,000 units. And you look at the amount of managers and staff you got to have just to run that back office. So I think for us, we've been just kind of going slow and methodical up until about 2016. And then at that point, I formed my company, TRIAC. It was consistent of myself and my two partners, Carrie and Deborah. These two ladies they have 30 years of property management experience each, and they were the backbone to all of the properties that we had purchased prior. They were key in that lease down and lease up and the success of that first property, and really kind of taught me from a property management perspective what I can and cannot do with the property. And they really, the good thing is that here, but buying local, so we're local and you're local in Austin, so I'm sure you see this all the time. You get these out of town buyers coming in, and they're buying properties that everybody else who's local has passed on for a reason, and I'm sure the data might seem great, but there's a reason that nobody local is buying that property, because they know that outside of the data, there's the whole, I don't know, cultural and just what is that submarket that will take years to turn. But anyway, they've helped me avoid a lot of pitfalls, and most, I think all the properties we bought, except for one, which we sold, have just been phenomenal properties. So anyway, 2016, we my company, we merged together, formed TRIAC. And then in 2019, just last year in January, we made the decision, because we have all this expertise in property management, to go ahead and start growing the fee management. Because, in 2016, we merged. They were a standalone property management company. They had over 2,000 units, and they had started, as part of the merger process, started letting go of clients, and we're going mostly owner managed. But then in 2019, as I mentioned, we decided, you know what? Maybe that's the wrong path. Let's grow the fee management. Let's grow both from both ends. And so just in the last 12, we're an owner this month, and we took over another one in Lufkin last month. So we've had tremendous growth. We've got about 250 units on the fee managed side that we're taking over. So we've decided, we're going to grow the fee managed side, and that way we're not, we've got plenty of fee income coming in, and we're not going to be rushed on the owner management side. Because the worst thing you can do, and this, is to to have financial, it costs money to run a company, and to have those financial constraints force you into buying a deal that maybe you don't want to buy, or probably shouldn't be pressured into buying. But for us, on the fee managed side, it's allowing us to grow TRIAC exponentially faster, and you're always going to be able to grow fee managed companies a lot faster than owner managed.
Yeah. We will go in very deep into that, but I want to get back to your beginning part itself. I mean, you gave us a lot of information here, so I want to really dissect into one by one. So you're originally from Papua New Guinea. That's
no, not from Papua New Guinea. I was working in Papua New Guinea. No. Google Papua New Guinea. You would know there. It's an awesome place. I lived there for 2 years. I was working in a compound, and it was basically like living inside of a National Geographic magazine. Like everything you would see in those magazines, I saw. I saw, people in tribal outfits, and I saw bows and arrows, and I saw tribal wars between one tribe and another, and I saw some pretty nasty stuff as well. It's pretty gruesome stuff, but nonetheless, it was a heck of an experience, and certainly learned a lot as well working for Exxon.
Yeah. Oh, working for Exxon. Okay, good. Yeah. I mean, I came from Malaysia, so I know near Borneo, and I've been to Borneo, and there's a lot of beautiful forests.
My business manager was from Malaysia.
Oh, yeah. Cool.
Yeah.
Cool. Yeah. All that, oil producing countries, right? So let me get into the timing of your start and the market that you started, right? You started in Houston, right? I mean, I believe even when I started in 2013 with even my single family, Houston was like the top market, right? I mean, much better than Dallas. I mean, right now everybody talks about Dallas and Austin, but at that time, Houston was like the top market for past few years. And how was the situation when you're buying your first deal? I mean, so you were working full-time as an engineer in Exxon. And then how did you make that transition to, hey, let's buy multifamily? I know you said you had an investment club that you learned some things, but how was your mindset shift from being an employee to now I want to be into a real estate investor?
Actually, first, so I'm going to get to that question. But first, so I do have I told you I had a big announcement. So I want to go and give the big announcement before, if that's okay. Because I know this story I'm about to tell you like the back of my hand. I've given it a couple hundred times. So, but the big announcement for us, everybody knows. So TRIAC Real Estate Partners, it's actually two companies. It's TRIAC Properties, which is our owner management side, and TRIAC Living, which is our fee management side. And then effective today, we're launching a third company called TRIAC Construction, which is going to be our renovation side of the business. As we're going to talk about, we've been pretty heavy on the value add side. We're pretty good at this. Right now, we've got a $40,000 per unit renovation underway, which is just a monster renovation. And part of what we feel is missing in the market, especially when it comes to the construction side, is a kind of turnkey approach to multifamily renovation. You've got a lot of these operators who can see, rightly so, that there needs to be a renovation, some value add improvement, but they don't fully understand how to, aside from the physical calculation of what it's going to cost, they don't understand the execution side of, okay, I've calculated what it's going to cost, but there's this whole other side of, okay, now I've got to implement it and execute it. And how do I do that? And so what we offer as far as a service from the construction side is not only can we build it for you and we can do the renovation, but we're able to tie that with our management company. And so you've got a seamless communication between the team that's managing the property and the team that's renovating it, so that you have the highest probability and chance of successful at your value add. Because I've seen, my first deal, we lost $80,000 on the carried interest alone because we executed it poorly, and yet we still made over 200% return. So we were successful in spite of ourselves. But on deals these days that are so tight, you really have to have very good communication between the operating team and the renovating team. And those days and weeks that go in between between your meetings, assuming that you're having them, can really make a big difference. If something is missed, and if you don't have a more seamless communication, it can really cost you a lot of money as far as the renovation. So anyway, TRIAC Construction is strictly here for the Houston market for now. So if anybody's out there doing renovations, definitely get in touch with us. So we're definitely excited to be rolling that and offering that service. So anyway, there's my big news.
Oh, awesome. Thanks for the news. So let's get back to the question.
So
on
Houston,
2011,
2011. So the big adjustment for me. Now, part of the backstory for me is I was working overseas, and the best thing that ever happened to me was getting laid off from my job at Exxon in like 6 months after buying that first property. Because there's a saying that I've heard, and we both know, I think, the guy it came from, Mr. Del Walmsley. I'll give him credit where credit is due. But he used to tell me this thing that said, "What gets in the way of a good life is a great life." And I had a really good life, and so I had this property that I wasn't really even paying attention to because my monthly income was huge, and so I just wasn't giving attention to it. Anyway, lost that income, and so suddenly I started really paying attention to that complex, and it wasn't doing so hot. So that was I took about 6 months off, and all I did was I joined a real estate group, Lifestyles Unlimited. We can say good things, we can say bad things, but nonetheless, I joined them, and they did help me get over. They were a great, I would say, stepping stone. I'm not endorsing anybody to join them now, or I'm not saying don't join them. I'm just saying, for me, they were a good stepping stone. 2011, they didn't have all these podcasts. I had books. And what got me to get into the industry was, since you asked, I just read books. I read 6 books. And the first book I read they were just contrasted single family versus multifamily. And the thesis of the book, or the summary, was single family is great. Percentage wise will always kick ass compared to multifamily, but volume wise, it's not there. So if you have the money, go straight to multifamily. I had the money, I went straight to multifamily. A couple more books. I read one on analysis, and basically just self-taught myself real estate or multifamily. Plus, I'm an engineer by trade. I was managing about $1 billion in costs for Exxon, so I was pretty good at this numbers thing. So I felt, and I was also 24, 25. So I had a little bit of ego to me. I thought I was invincible. So I went and bought that first property. It was me and a friend. We went 50-50 on the deal. And so that's how I got interested. Read books, got into it. And then what I realized was that I was like a master at the 30,000 foot level because I'd read these books. But when you get down to the day-to-day of what's going on, those books didn't tell me how to do a due diligence. And I'm sure maybe there's books now that'll teach you. And I know for sure there's podcasts. There's so many resources now compared to when I got started that, I feel like people these days, investors now, have such a huge advantage to getting in the market. But the only advantage that we had in 2011 was the housing crash had just happened. So we were buying stuff. Bought my first one at $25,000 a door, which is another reason why everybody thought that $8,000 per door renovation was crazy, because I was spending more on the rehab than I did on the purchase price. Just imagine that. And now it's worth over $130,000 a door. So it's, you know, it worked out well for me. That's how I got in. And then I actually didn't go right away. You know, nobody goes full real estate. You don't go 100% into multifamily on your first deal. As far as like being able to sustain yourself, especially, you know, for me, I came from I was a high income earner, and that's the hardest thing to replace a high income with multifamily. It takes a long time versus, and I'm not saying this to be insulting at all, so please, but if you're starting from a lower income, it's a lot easier to replace that lower income versus if you already have a good, strong 6-figure salary. That's going to be harder to replace that on a regular basis that you can depend on in multifamily. You have to buy a couple deals. And so what I do, I had a day job just like, you know, everybody else. I had to support myself for about another year, bought 2 more deals, and then refinanced the first. And then finally, I had enough, at least on the, when I refinanced and got I got double my money back from the first deal. Plus I had some residual ongoing cash flow from 2 deals that we just bought. That's when I made the decision, go ahead and exit, go full time, because I had, you know, a pretty big reserve built up and I felt comfortable and we're on a good track. But I know, you know, some people are buying faster and slower. That was just how we did it, you know.
Got it. But you started, even when you started with the deep value add, right? Like deals where you have to put in like 30,000 a door, 40,000 a door.
I don't want to pretend like it wasn't intentional. When I bought that first deal, it was supposed to be a 3. So that was the other side of the story.
Okay, I think we lost your word. You said it's supposed to be 3,000?
3,000, 3,000.
And then it went to 30,000?
30,000. So I missed the mark by, you know, just a little bit there. But you know, that was my
Thanks
first
for being
deal.
honest, because I think that's very important for.
Oh, absolutely. I think
people to say that there's a huge chance of you making mistakes. No matter, you know, you have a mentor, no matter you have a club behind you, you can still make a mistake, right?
The thing that worries me with everything, you know, with the SEC 506C and all these, making it so easy to raise money publicly, is you got so many people trying to like fake the funk, so to speak, where they're just, which is fine if you're applying for a job and you're trying to make your resume sound like you did more than you did. But here you're raising money that's people's money that you could potentially lose. And so that's, you know, that's not cool. And so I think with us, like, we're very honest. We say, yeah, like I screwed up the first deal, and we were off on my third deal that we sold for almost a 200% return. I projected a 300% return. So I was, you know, I learned a lot on the way. It's very hard to get the projections right. You know, multifamily, and you know this because you're a CCIM, multifamily is one of the hardest classes of real estate to underwrite, harder than office, harder than retail, because you got so many tenants, so many parts, that to really do it and do it well is challenging.
Yeah, I think what you're saying is it's hard to underwrite, and after that, execute the business plan based on the underwriting, right? So
yeah, oh yeah.
But I want to really go into this. How did we had so much delta between 3,000 and 30,000? Because I think it's a good learning that someone else can take simple. It. And so let's go deep into that. How did you thought it was 3,000? And how did it was 3,000 per door?
Because our broker, who I think he's retired right now.
Okay, but he's safe now. Then.
Yeah, I don't want to call his name out. But anyway, he was a crazy guy. Had like 9 cats and was posting cat. He was literally posting cat. It was a weird thing. But anyway, on his broker memorandum said 3,000 per door. Okay. And so we're like, oh, why? He would know. He's a broker. Why would he lie to us? And I don't think he lied to us. I mean, I don't think any broker lies to you. I think they just don't know. And so we put 3,000 a door. We're living in Papua New Guinea. We're 24 years old. What do we know?
Okay, got it. So you bought it from out of country then at that time, sight unseen? Sight
unseen. I didn't see the property until 2 months after I owned it.
So you probably had too much money to put into this kind of deal without seeing it. Okay, I mean it's okay. Yeah, it is what it is.
I bought that property like somebody would buy a rental house. It wasn't.
Okay, got it.
I just knew, and the reason I bought it was because all my managers, all they talked about was like, oh, just either they did some vacation, they bought some hot stock, or they bought real estate. So I wanted to kind of, show them up and be like, I bought an apartment complex.
So, and how many units was that, Joseph?
26 units.
26 units. Okay.
25,000 a door.
So how did you 25,000 a door in 2011? Which I think probably a market rate at that time in Houston, if I'm not mistaken.
I wish if I had a time machine, I'd go back. Things you don't know. Like, who would have thought that prices would have escalated this fast? And that's the other thing that worries me. Like, since we're talking about just being honest with with what's going on, is I'd say equal parts of my success have been from underwriting and from just riding the market. They say a rising tide raises all ships. Raises all ships. We've been on just the most phenomenal bull run of the real estate market as the cap rates have been getting compressed more and more. But now you're starting to see them kind of plateau. And so now if you want to get returns, you truly need to generate those returns through a proper execution of the investment. You're not going to be able to bank on cap rate compression when you exit 5 years from now. If anything, you've got cap rate expansion that's fighting against you.
Got it.
So that makes it really hard to get returns these days.
Yeah. So coming back to this $3,000 to $30,000 difference, right? So once you landed in Houston and you visited the property, is that when you realized that the cost is a lot, or you just you took
no?
Before?
So the realization, here's when the realization happened. We were 4 units into the rehab on 26 units. That puts us at like 85% vacant.
And you had a third-party property management company.
We had my third-party property manager. Again, I'm green behind the ears. I don't know what I'm doing. I hired a single-family property manager who was making his first attempt at multifamily on our deal. So we had, the blind leading the blind. He didn't know what the heck he was doing. He was a bit kind of a conflict of interest because he kept trying to push his own construction company to do the rehab, which was a luxury, like this luxury construction company that did single family, which was anyway. So he's doing this rehab, he's managing this. He is the property manager and the construction manager for what we're going on. Because again, we're still living in Papua New Guinea. So by the time I come back and realize what's going on, we're 4 units completely down to the studs. And then we are doing our AC permit because you got to do a permit to install ACs. And as part of that, actually, no, you don't. I don't know if you needed to. Anyway, he was trying to do everything by the book, which I'm not saying don't do it by the book, do it by the book. But obviously you want to try and save money if you can. So he was doing everything by the book. We did a permit. Part of that permit was environmental, which any real estate syndicator now knows you get an environmental. It's just a check the box thing. It wasn't for us. It wasn't required at our closing. We never did environmental. So we did the environmental, came back hot for asbestos. That's when and it's funny because it was basically within 30 days, we got notified that the property had asbestos. I lost my job. And then in addition to that, the insurance that we had purchased was fraudulent insurance. So we didn't actually have insurance. So yeah, I was in a pretty bad spot. And then that's when I joined the real estate group and met my partners, and the solution to that situation, which is a kind of a rare situation, maybe not rare, but sometimes you come into these situations where you can just throw money at the problem to fix it. And so that's what we did. We were like, look, if we sell the property, now that we know it has asbestos and we know, and we're 4 units down that we can't touch and bring them back online, so I'd have to sell it at 85% occupied, I'm going to take a loss. So I can either take a loss or I can roll the dice, do this massive 30,000 per unit renovation, because the neighbors behind me were like, the house values behind us were over almost about $1 million. So we were in a very affluent area. So we rolled the dice, and I had my 401k from after my job at Exxon and cashed the whole thing out, went all in on that deal, and did a lot of praying. No, we knew at that time, though, I felt a lot more confident with what we were doing.
Okay.
We knew the numbers, we knew the market. It was just now I was learning a lot on execution with everything that needs to happen for a major renovation. we're now doing our third major renovation where you're doing almost down to the studs and back up. So it's, learned a lot on the first one. Second one, we did a phenomenal job. And this third one, we're just knocking it out of the park.
Got it. Well, it's very interesting that the experience you went through on the first one, I'm sure it stuck with you on the next few deals, right? Because now you shouldn't do certain things. You must do certain process and checklists and make sure that you go through. Yeah. Was that a normal bank loan? Because usually the
so our lender, man, you're just asking all kinds of great questions. Yeah. Our bank was Internet Bank of USA.
I've
never even heard of these guys.
Never heard about that.
Yeah, we thought they were a joke bank. We're like, is this one of these scams? Because coincidentally, there was a group called ABC Funding that was based out of London that was trying to get us to wire them money so they would, it's kind of like these Nigerian prince things. And it was very convincing. We almost did it. But we finally figured out they were a fraud. But, there's a lot of, it's so easy to lose money in real estate. Everybody's trying to rip you off. So.
No, but who gave you the funding? I know there's some group out of London trying to get you money, but finally who gave you
So we bought the property with Bank of Internet USA.
Okay.
And then, which is also part of the story here, they had, banks annually will request, what is your occupancy, Correct. Your financials, and what is your personal financials. And I had just gotten the letter from them a week before we closed on our refinance to pay them out and start a construction job. Because if we hadn't taken the actions we did at exactly the time we did, they would have known that your guarantor is unemployed with no income, your property is negative cash flowing, and you've got asbestos. And they would have, they probably would have tried to foreclose on me. We were that close to being in a pickle. But anyway, the bank that did the refi and the rehab for us was a local bank. They're no longer around. They're called First Victoria. They were purchased by Prosperity Bank.
Got it. Wow. All the things that can go wrong went wrong in that deal, I guess.
Yeah, it was, and that's why, I see these guys, that are, trying to buy deals out of state, these heavy value add deals. And I'm like, it's a lot of work. You've got to be there. The one we're doing right now, I was just there this morning. You've got to be there on a, if not every week, twice a week, just to keep tabs of what's going on, especially in the beginning, because, in the beginning when you're doing your test units, and you're trying to see how you want everything, it gets pretty crazy because that's when you're still setting. You can set things on paper, but then you go from, okay, you've set your budgets to, all right, let's actually get in there, tear the wall down. Let's see what's in there, find any change orders. Because, so we just closed on 220 units last September. It was, we purchased it for about $75 a door, 4.8 cap rate going in. And we're spending almost $40,000 a unit on the rehab. We're going to exit at about an 8 cap. So it was, it's a short-term deal, about 4 years, in and out, do this rehab, increase the rents about $450.
So how did you come up with the $40,000 rehab? That still seems to be
40,000.
Yeah.
Yeah. Well, for us, this deal was pretty simple in regards to coming up with the scope. Part of the challenge on a lot of deals is, okay, where am I going to spend the money to upgrade so that you're not overspending and you're not being wasteful and just spending money in an area that doesn't do anything for the value. Because it's very easy to do that. You can buy all new doors on something. It doesn't mean you can increase the rent $100.
Correct.
So for us, there was the neighboring property that had been renovated. It was just finishing its renovation, and they did the exact same thing. The building was identical. It was the same architect and everything. They were near identical twins. So I was like, we just sent our GC there and we said, okay, do that, copy that. So he went through, he came up with the scope to do that. And that's how we came up with about $40,000 a unit.
So $40,000 is including the exterior, I guess, right?
What's that?
It's including the exterior renovation.
Interior, exterior.
Okay.
So high level, we've done all new roofs, replacing about half the ACs, all new windows, which is very expensive, all new plumbing, also very expensive, adding washer and dryers, gutting the kitchens, all new appliances, all new floors. We are redoing the floor plan in the kitchen to add the washer and dryer. So we knocked down a wall, made the bedroom bigger. So we've completely changed the floor plan of about 50% of the units. We've got, because those are the ones we're in. Now, when we get to the other 50%, we'll see what we're going to do to those units. What else are we doing?
So yeah, that makes a lot more sense because you are doing roof, you are doing changing the floor plan as well, right? So that makes a lot of sense in terms of
redoing the office. We're also building 2 additional units. They got this giant. One of the properties, it's 3 properties, which it was a portfolio of 3, and they're all on the same street. One of the 3 had it used to be unofficially used as a senior living, and so it had this warehouse type building that was used, I guess, as the recreation room / cafeteria.
Okay.
And now it's just vacant. It's just sitting there vacant. So we're going to, at the completion of our project, the last thing we're going to do is go into that building and gut it and create 2 units out of it from nothing. So it's that's going to be an expensive addition, about $50,000 per unit just for those.
And what kind of financing are you doing on this? Is it like a...
so we've got bridge debt on it. We used a group called LaSalle. I think they're out of California. Great group. They've been really good to us. So yeah.
Got it. Yeah, that's like a huge change, $40,000 a door. So I mean, you really need to be really skilled in controlling expense, right? And making sure you get the rent that you want.
We've proven the upside already because again, the neighboring property, when we did our pro forma, our rents, we budgeted them at $100 below theirs. So just to be on the safe side, and even that was a 2.2 equity multiple, 23% IRR. So if we actually hit their rents, it's going to be even higher than that.
Got it.
So it's going to be a very, very good project. But so we had a lot of confidence going into it that we know the rehab, we know the scope, and we know the rents. So then truly we just got to make sure we execute this amazingly. And we were off to a great start. Sorry to interrupt you. We were off to a great start, but then you never know what's going to happen. And so for us, we on a morning, and then by that evening, I don't know if you recall, Houston got this massive rain. It was wasn't a hurricane, but it was a really heavy rain. And anybody who's in the Houston area knows that it has an issue with flooding. So this property, first of all, luckily we closed it. We put flood insurance on it. It didn't have it before, but we'd put it on just in case because it's Houston and you never know. I've had properties that are in a flood zone that didn't flood for Harvey, and I've had ones that are not in a flood zone and I've got almost flooded. So anyway, we just go ahead and we put flood insurance on most properties we buy these days. We did on that one. By the afternoon of when we closed, 22 units had about 1 inch to 2 inches of water in them on one of our properties. So we had to rip the sheetrock up to the studs, up 18 inches, vacate 22 units. So right out of the gate, we had this plan, okay, we're going to start the rehab on January 1. We're going to spend the next couple of months getting everything in order. We weren't able to do that. So in September, when we closed, I think the 19th, the next day, we're working on relocating, help them out with their belongings, and then stripping down units. So the good news of all that, we did get a claim out of it. We've got, we paid really well on those units. So those units will actually be profitable right out of the gate.
Got it.
Extra contingency, so to speak.
So let's say, out of this 40,000 per door, budget that you have for this latest deal, let's say your budget got cut into half, 20,000 a door, right? For this 220 units deal, what would you prioritize in terms of value add? I'm trying to find out what is the most valuable value add that you want to do to at least come back to your
part of the reason why it was so expensive is that we had so many items that were deferred. We had a lot of deferred maintenance. And the problem with deferred maintenance is there's no value there. The resident, there's no value in, resident's not going to pay you because the roof is new. They should, but they're not going to. So for us, I don't have the figures, but off the top of my head, I know the roof was about $1,000 a unit. I know the plumbing was about $5,000 a unit.
Okay.
And the plumbing, people say, oh, there's no value in plumbing, and that's why nobody ever does it. But there is value. Right? If you want somebody to move out quickly, then put them in a unit that has very low water pressure. And I can almost guarantee they're not going to renew their lease, because if they can't take a shower in the morning, it could be the most beautiful unit that they ever seen. But if they can't take a shower in the morning, they're not going to renew. So for the roofs, we were at like $850 a unit on the roofs. And so we had all these different items that made up that. So that property, I couldn't really tell you. If I only had $20,000, I wouldn't have bought. If I only had $20,000 per unit, I wouldn't have bought the property. Because
let's say you already buy it and now you are stuck with it. Now you have $20,000.
Yeah, the only way that property works at that price is you go big. You got to do a massive renovation.
Okay.
Otherwise, I would have had to pay $20,000 less per unit to make it work.
Okay, interesting. And what about the interior unit rehab? What are the rehabs that you usually prioritize to get the highest rent bump?
So for the interior, kitchens are big. Kitchens sell. And we were actually playing around with this one, trying to do a combination of like, I don't know if you've seen convection microwave ovens, because we've got some efficiency units. And so we've got like 6 of them that instead of putting a full appliance set, that we're going to go and put just a microwave convection oven, so that 2-burner stove, just a 2-burner glass top deal, and then a fridge, and that'll be it. They won't have any oven; they'll just have that microwave that also has convection. And so that's what we're playing with there. But I think again, kitchens are huge. Having really good fixtures and a good design, and so everything flows. We've got a professional designer that we're using for the whole thing. We're not doing any of it ourselves, and having all of that kind of flow and have a good look to it does well. So I think if you spend money on the kitchens, I think you'll be okay, because that's where they're at a lot of the time. People spend a lot of time in the kitchen, and then bathrooms as well. So we're doing all new bathrooms, new tile surrounds, new tubs. And then also for us, one that's going to really hold you back on the money is really try to add washer and dryers, especially when you're going to these new units. And for us, like if you don't have the space, like we have 650 square feet on most of these 1-bedrooms we're doing. And what we're doing is a stackable front loader. Front loaders are more expensive, yes, but we're appealing to a higher profile. Our rents are $170. So we're getting crazy high rents. And so part of our pitch is appliances. We've got really nice appliances as well. And that includes the washer and dryer. We're not giving them some cheap, some cheap top loader with the agitator in the middle that destroys your clothes. People like to have nice appliances. So I think make sure you get washer and dryer. And if you don't have space, just be aware that you can stack a front loader on top of each other, and it takes up next to nothing.
Got it. So your strategy is to really spend a lot of money per door and get the highest maximum rent that you can.
It's not really a strategy. I mean, it's just a skill set that we know how to do. It's just like knowing what techniques you need to apply on a certain property, given the scenario, in order to make it successful. If I could have had a 200% return and spent much less, then I would have spent much less.
Got it.
I'm not recommending that everybody go and spend $40,000 a unit on every property. I think that's. I was telling my new partner on the construction side, I was like, we really got to, and we may never see a $40,000 per unit property again. I mean, I never thought I would see a $30,000 per unit, and that's been the case. Most of our deals have been $10,000 per unit, and less. I'll say because there's so much education out there from like people like yourself and who, owners know now that they can resurface the counters, they can redo the floors, they can do a lot of this. And so it's very rare that you're going to pick up a property that's untouched. And that was part of the story on this one. It was untouched, which it really shouldn't have been, considering who the previous owner was. It really should have been previously renovated, but that's another story.
Yeah. I mean, I've done like 10,000 per unit per door renovation, and I thought that was a lot because we had like stainless steel, we had crown molding, we had exterior, interior painting. We did like not a new roof, but everything else was changed. It looks really, really nice. And I just
you
can't
find
imagine
value in the crown molding?
Not anymore. I think in the beginning we had the budget. We really liked the way it looks, but I don't think so. It's really catered for the renters.
Yeah, we don't do it. One of the things we're doing here that's, again, it's expensive, but we're scraping off the popcorn ceiling.
Oh, got it.
So you've got smooth ceilings. It's the modern look.
Really? Okay.
We're also going with black windows, which, so we had $150,000 change order because we went from white vinyl windows to black. We can all agree that material-wise, there was zero additional cost that vendor incurred, other than that they're now black, and black is more trendy now and popular. So now they increase the price, $150,000. But anyway, that's. But we installed several of them now, and they look amazing.
I have never seen a black window.
It's super cool. Yeah,
you must be a new trendsetter. So I need to come and visit your property.
When you drive by the property, you look. You can't help but notice it. I feel like vinyl windows, the white ones, they're nice, and if that's all you can afford, great. But it's going to date your property to an older style. And with what we were doing, it's all about style. And so we had to kind of go the extra mile and be the coolest kind of hip property. We've rebranded the whole thing. It was Candlelight, now it's called the Melrose. Going for this kind of South Beach, not South Beach, what do you call it? A California kind of beach, Laguna Beach kind of theme. So it's going to be really cool. Palm Springs.
And what is the price difference between the black and the white?
It was about $150,000 across 220 units.
Okay.
Yeah.
Do you know like price per window difference?
Not off the top of my head. No.
Okay, that's fine. Yeah, it's interesting. I mean, that's something new that I've never seen.
Because it's going to depend on, some units have more windows than others. But I can just average it. You just do 150 over 220 units, whatever that comes out to.
All right, Joseph, why don't you tell our audience how to get hold of you and your company?
Yes. So the best way is just shoot an email to info@TRIAC, TRIACREP.com. They can also call us, my direct line, 281-836-4181. Those are the best kind of ways to get in touch with us. You can also check out our website, triarcrep.com. Or, we just moved into our first office space, which, is a good feeling, a good milestone for anybody when they're growing their company. We just moved into 3,500 square feet. So we're here in Houston. We're at 290 and Mangum at that intersection. So if you're in the area, shoot me an email. I'd love to meet with you, and we can show you our team and show you some of our properties.
Awesome. Thanks for coming on the show. You added a lot of value in terms of deep value add renovations, right? What are the things that you guys are doing? And this is really deep value add is what you guys are doing. Yeah. And I just love the deep value add because you make a lot of money if you execute it right and if you turn it around.
You can lose a lot of money too if you do it wrong. So
that's what I'm saying. If you execute it right, you need a really strong operator. To really manage the expenses, the contractor management, the turnaround process, the rent increase. There's a lot of steps, a lot more steps than buying the cookie cutter value add deals, right?
Yeah. It's not like, because most cookie cutter deals you can manage just with your operations team, turning units on an as they come available.
Correct.
We actually have a full blown schedule for this thing that we got developed. So it's it's a major project. It reminds me of gives me flashbacks to working for Exxon when we're building that project. We have the same. We're approaching it with the same mentality, the same project management heavy approach.
Got it. Well, thanks for coming on, and talk to you soon.
All right, see you, James. Bye.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.